Good morning, Wall Street. In this video, we're going to take a look at yesterday's intraday action, which was a quintessential example of why bias is so important in making trading decisions. This is a chart of the S&P futures contract on a 5-minute basis. And yesterday morning, the market gapped down below the green support level. And you can see these two blue lines are the first hour's high and low. And this whole range here of the high and low of the first hour was below the green support level for the value line. So that clearly puts the day on a negative bias. In fact, the only rally of significance that the market could muster was a feeble attempt in the second hour to define the first hour's low as resistance. And for the rest of the day, it never got back up to that level. By our rules of bias, anytime the market is below this green support level, the bias is negative, which means that we only take short bets. If the market was between the resistance and support level, we'd be considering taking both sides of the market. And of course, if the market had been above the resistance level here, we'd only look at long trades. As far as the DMA channel on a 5-minute basis here is concerned, the market did have an attempt to rally above it in the later hours of the day, only to fail into the close. So by possibly triggering a long trade here, you would have been sucked into the market only to take in a loss ultimately. Because the bias says don't take this kind of trade, you wouldn't have been enticed into this kind of action. This is also a 5-minute chart. It shows the Heikin-Ashi trend direction candles, which basically gave you a lot of false positives here, a lot of false buy signals here, and here. And all of those buy signals really wouldn't have been very rewarding. And of course, we didn't take those because the bias was negative. Taking the sell signals when it's red, when it turns from green to red, much more rewarding. There and there. We had choppy action in here, but that was when, if you recall, the market was above its DMA channel. But as it moved below its DMA channel again here with the red and the Heikin-Ashi, nice sell signal. Other signals that really didn't work too well on the long side was the positive divergence in the volume swing indicators, which didn't yield anything in the way of positive action in the market yesterday. And the slight move above the zero line was a horrible time to try to get long in this market. Looking at our adjusted rate of change, in a good market, this would have been a speculative buy by the rate of change moving above its signal line here. But because the bias was negative, it was a horrible time to think about going long. In fact, the market did nothing except go lower after this crossover. You even had the rate of change poke its head above the zero line here, which should have been more of a buy signal. But again, these are not great entry points. And the reason why is because the bias is negative. And let's take a look at our ENS, the Erlanger Nantucket Sleigh Ride indicators. You get a good sell signal on the ENS right there. That's not a normal looking oversold pattern. You are extending the period in which you were oversold, and that in itself is a sign of weakness. The one buy signal that you get here is the fast ENS going green and the ENS going green here. And yes, that gets you into this period where the market tries to move above the DMA channel. But it wasn't very rewarding. And that's the point. In a negative bias situation, the buy signals aren't going to get you very much. And of course, with the overbought here, very brief, the market collapsed into the close. So yesterday's action was a great example as to why bias can help you stay away from trades that otherwise you might be tempted to take. Hope that helps. See you next time.